Yeah, we believe a re-rating for Chinese equities can occur. We think that the Chinese economy is being stimulated. Our view has always been that Chinese equities as a explicit holding are pretty small for a lot of investors, right? It's only 2.5% of the global market cap. Conversely, global investors, and particularly US investors, are highly overweight US stocks, including US multinationals that have exceedingly high revenue in China. This evolution of technology in China is a very, very real trend. And if anything, some of the previous administration's tactics of trying to shut or cripple Chinese companies, it forced them to innovate.
Welcome to Global Money Talk. I'm Dan Ha. Our guest today is Brendan Ahern, Chief Investment Officer of KraneShares. Brendan, welcome.
Hey, thanks for having me, Dan.
So tell us about KraneShares.
So KraneShares, our founder, Jonathan Crane, moved to China in 2001, where he built a business geared to China's growing urban middle class. And really living in Shanghai, he experienced how China's economy was evolving away from purely being export manufacturing driven, that you had this new urban middle class and their spending was powering a new China. At the same time, 2001 was actually the first year foreign investors were allowed into the Shanghai and Shenzhen, the A-share market, the mainland market. But that first 2001 was really just the start of a liberalization and opening up for the mainland markets to foreign investors. And after a number of years, John sold his business to a U.S. multinational and ended up moving back here to New York. Couldn't believe how much exchange-traded funds had grown. But when he looked at the China ETFs, as well as China's exposure in broad-based emerging markets, it was all of old China. It was no new China economic sectors. And the definition of China was just a small number of Hong Kong listed stocks, none of this A-share market, Shanghai, Shenzhen. So he started down the path of creating KraneShares on these first two trends, the opening of China and new China. Over time, we've evolved the business beyond China. We've done a lot of things in carbon credit allowance futures trading, as well as listed a number of exchange-traded funds for partners like Hedge, a research firm, global macro research firm, or a Man Group of large publicly traded hedge fund family. So my core focus is still on the China side, where we really strive to provide a balanced, data-driven perspective on what's happening in China's economy and capital markets.
Okay. And what is your background?
So I had been hired by Barclays Global Investors. I've worked in traditional U.S. asset management here in New York, but moved to San Francisco to be part of Barclay Global Investors starting a thing called iShares, their family of exchange-traded funds. So I was part of the first 20 people within the firm focused on that new endeavor, and it really was a new endeavor within a much bigger firm. BGI was a big quantitative pension manager, but we had this new effort to do these things called ETFs. Turned out to be a huge success. Unfortunately, Barclays Bank ended up selling us to BlackRock, so I moved back and worked for BlackRock for a number of years. But I just coincidentally got introduced to John Crane, and when he spoke about this new China, and he was like, this company called Alibaba is going to go public. I was like, I've never heard of this company. This was back in 2012. But when he spoke about this opening up of China, my background in indexing, it's my belief that index providers are really kind of a hidden source of what creates markets. That they set the rules of the road, and that's where I've been a student of index methodologies for many years. And when he said, well, China's opening up, I just said, my theory of thinking was, well, if you have the second largest equity market in the world and it's opening up, what if it can go into MSCI indices? We're talking about almost 20 trillion of benchmarked assets. And if we can get in front of those flows, that's a business. And over time, it turned out to be more of our efforts around the China internet space, and really being one of the few people who knew anything about Alibaba when it went public, that our China internet ETF KWeb is one of the largest China ETFs globally, because it's really this growth factor on China. No energy, no materials, no industrials. Where that's been a lot of the issue, not just for investing in China, but broad-based emerging markets, and really for non-US equities, is you have all of this old economy that's a big part of the weight, and that's what we've done that's arguably a little bit unique relative to some of our peers in the space.
Got it. I was going to ask you about the uniqueness of Crane's offerings relative to other China ETFs. So in addition to sort of that sector differentiation or sector focus differentiation, what else would you say is unique about your offering?
Yeah, and I think on the sector side, if you went back 10 years ago, 50% of MSCI China and MSCI emerging markets were actually just in two sectors, financials and energy. And if you throw in industrials, materials, real estate, it was a value factor. And unfortunately for broad-based EM and broad-based China investors, tech was only 10% of EM, actually beat the S&P 500 since the GFC low. In the case of China, tech was 2% of the index.
Oh, wow.
Did more than double with the S&P 500 since the global financial. So just this pulling out of these growth geared names is still unique, but we've certainly feel like there's other growth opportunities, particularly healthcare. They've done a thing called the Star Board, which is kind of their version of the NASDAQ. No disrespect to being here in the New York Stock Exchange, but it's just really for growth companies. So yeah, we still think there's a lot of opportunity in these growth sectors, and we think when foreign investors come back to China, and even for a lot of domestic investors in China, when they come back into the stock market, they're going to buy these growth names.
Right.
We really do believe that.
Right. I do want to go deeper into growth versus value in China, but before we do that, tell us about your near-term and long-term views on the China equity markets, just to sort of set the stage for our discussion.
Yeah, we believe a re-rating for Chinese equities can occur. That Chinese equities are only 2.5% of the global market cap, and we think that the Chinese economy is being stimulated. That's going to be a process. They have a real estate crisis, but the government is very focused on it. We think the geopolitical overhang has been a major constraint, but it is our belief that under this new administration, a U.S.-China trade deal can get done, and that will allow institutional investors to come back in. We're already seeing Chinese investors buying Chinese stocks and exchange-traded funds. Some of that's through the southbound Stock Connect, mainland money coming into Hong Kong, 103 billion last year versus just 40 billion each of the last 2 years. So the Chinese are buying China, and then the Chinese companies are buying back their stock, and particularly for these growth tech companies, the founder is either the CEO or the chairperson of all of the companies in the China internet space, in the KWeb space.
Yeah.
And if they felt the Chinese economy was doing so badly, wouldn't they be hoarding cash? And the other one investor that's getting very active in the space are hedge funds.
Okay.
And hedge funds are not beholden to investment committees, board of directors or trustees. They just want to be able to buy low and sell high, and they don't have some of these constraints that we think have kept some institutional investors from doing what their MBAs and CFAs know they should be doing, which is buying low. We really do think that cheap China tech is an opportunity today, and if anything, the DeepSeek revelation recently just exposes that these Chinese tech plays are maybe a little bit further along than many investors are aware.
Got it. Does that hedge fund flow help with the re-rating of the market, though? Because wouldn't it, they're sort of more short-term oriented, could probably push the price higher for a little while, but like you said, after it goes up a little, somewhat, they're probably going to take profits and get out. So is that really helping the re-rating?
Well, we think it's a small start, and we would agree that, the other thing that these hedge funds can do is they can trade around a position. They can use option liquidity to hedge.
Yeah.
So those are some things, they can do some things some investors have a harder time doing, and that maybe allows them to ride out some of the volatility in the space. But today in Hong Kong, on any given day, more than 40% of the volume is coming from mainland China.
Yeah, okay.
And so it just shows that just a small re-rating from global institutions can have a real impact. I mean, this is a, really, really big money has come out of the space for a host of reasons: the real estate crisis, zero COVID policy, geopolitical. But we think a Trump President Xi summit, a Trump visit to China, talk of a trade deal, we think that lifts some of those geopolitical restraints. And we would say it's not just the hedge funds coming into, like, corn and soybean since Trump got elected have really appreciated. And you'd say, what's driving that? Well, what is China going to buy in a trade deal? It's going to be U.S. agriculture. Okay. So we think actually some of the commodity markets are actually kind of forecasting a U.S.-China trade deal. And even recently, where Trump, kind of whacked Mexico and Canada with 25%, he only hit China with 10%. That maybe the U.S.-China trade dialogue is further along than the markets realized.
Got it. If the expectation is that there will be a trade deal, which will be good for China and good for Chinese equities, kind of coming back to what I was saying earlier about value versus growth, doesn't that have the potential to actually help the more sort of value sectors of China, or is that not your view? Well,
we think there's the way, and we do think about it between value and growth, but we also think about it between onshore and offshore China. That onshore China, Shanghai, Shenzhen, predominantly, virtually completely owned by investors in China. So it's almost a running barometer of what do the Chinese think about China. And that would be that they think the government needs to do more to solve what's happening in terms of real estate, to kind of stimulate domestic consumption. Offshore China, kind of Hong Kong and the US ADRs, it's more of what do foreign investors think about China?
Yeah.
And in that case, we would argue, it's our belief, that foreign investors are going to be much more interested in the Alibabas and Tencents and JDs and Pinduoduos as opposed to a PetroChina or an ICBC, like a big Chinese bank. And so we think the foreign investors will always come back to these growth names in the offshore market. Onshore China, very different market. They two markets, really, because there's no fungibility, they really do move differently than one another. And we would argue the onshore market really is waiting for the Chinese government to do major policy stimulus around real estate, as well as stimulating domestic consumption, something that they've been doing incrementally, but just not on a very, very significant scale.
Got it. When you talk to these local investors in China, what do they think about the long-term sort of drivers of economic growth that'll get China out of the troubles that they're facing right now? I mean, I hear a lot from global investors how China is too cheap. And when, a market is too cheap, you will find opportunities. But rarely do I hear of, at least folks here, people that I speak to, talk about China as sort of the next big secular growth opportunity. It's really more of a deep value trade type of. So, what do Chinese investors sort of, how do they see it differently, or do they see it differently?
Yeah, it's a good question. I think in China, I was just there a few weeks ago, and going to Hong Kong and Macau and then Shanghai, visually it seemed totally normal.
Okay.
That, Western media, you'd think buildings were on fire or something. That's not the case. Going to some of the casinos in Macau, just absolutely jam-packed. And this was in advance of Chinese New Year. I mean, it just made me think of, how much more crowded could they get? So visually, China seemed, very normal. I think, one of the main takeaways from this last trip was just the extent of how the real estate crisis has weighed on consumer confidence, that upwards of 2/3 of urban wealth is invested in real estate. And, if you lose in one part of your portfolio, you're going to be more conservative. So the Chinese continue to save. They continue to be very conservative in their household expenditures, and that's led to this tepid growth. The real estate crisis has also weighed on the real economy because less new construction means less construction workers working, less electricians, plumbers, less home furnishings. So the knock-on effect of it is a real situation, and I think the government has been doing things incrementally. Real estate transactions were up about 30% in the month of January, year over year. Tier 1 cities, prices are starting to stabilize, but in those lower tier cities, you're looking at still pretty significant losses. And a lot of talk on this last trip of, does the Chinese government go in and nationalize some of these distressed players? They start going in and buying real estate projects and using that unsold inventory as affordable housing. And arguably just like a week ago, you had Vanke, which is a state-owned enterprise, that its local government, the government of Shenzhen, basically took over the company. That a local government official is now the chairman of the board.
Yeah.
And so it isn't that Vanke was nationalized, it was almost localized. Yeah. But is that going to happen to other big players? Is that the path? And I just think that they really do, this real estate is a big issue. And if they can solve it, it'll bring back some of that animal spirits for the domestic economy where export-driven manufacturing has been really strong. And that is almost why they have to do a deal with Trump. They can't have the one part of their economy that's done well. They can't have that leg of the stool swept out from underneath it while they're dealing with trying to figure out how to solve this real estate crisis.
So that taking over by government official of real estate company, that one example, and perhaps we'll see more of that. What's the implication of that? Is that positive? Is that negative?
I think it's ultimately positive that you need almost a clearing mechanism, and that's been happening over the last 2+ years. China's real estate crisis is very different from the U.S. financial crisis. You don't have the amount of leverage and exotic derivatives, but it is a problem because of how it's weighed on the domestic consumer.
Yeah.
And so if you can solve that issue, if you can stabilize prices, there's a lot of built up wealth that's going into bank accounts, it's going into the bond market. I mean, it's just, China's bond market rally has just been incredible. Where you've got their 10 years down to like 1.6%.
Right.
So there's a lot of dry powder. I think for foreign capital that would go into these growth names offshore, it's the geopolitical. It's just, how do you walk in to your boss and say, we're going to buy cheap China tech when their source of information is Western media that is always negative? And I think that media narrative can change just with, a Trump-Xi summit being announced. And is the market prepared for that? I don't think it is.
Got it. So your positioning is sort of predicated on the expectation that there will be a trade deal. If there isn't a trade deal, does your view about the Chinese market change?
Well, our view has always been, listen, the Chinese equities as a explicit holding are pretty small for a lot of investors, right? It's only 2.5% of global market cap. Conversely, global investors, and particularly US investors, are highly overweight US stocks, including US multinationals that have exceedingly high revenue in China.
Right.
And people will say, well, I'm so worried about China, and then what do they own? They own Apple.
Right.
16% of revenue in China. Tesla, 25%. ExxonMobil, more than 10%. Qualcomm, NVIDIA, the chip stocks, huge sales. So if people are worried about this worst case scenario, you should be much more worried about U.S. stocks, particularly at these valuation levels, than Chinese stocks where people have very low weights.
Yeah, got it. What are the long-term growth drivers for that economy in your view? Is it, I'm sure the consumer is a big part of it, but in addition to that, what do you see as sort of the economic drivers over the next, call it 5-10 years for that economy?
Yeah, I think the consumer, just this growing urban middle class, will continue to expand, and you can ride that through the internet companies, if it's mobile payments, e-commerce, online gaming. There's a whole host of companies that will gear to that. At the same time, China is aging. There is a demographic issue, and we believe healthcare will be of increasingly importance. China does have some structural issues like demographics, where we think part of the solution can be in dealing with the real estate crisis is actually addressing some structural issues and demographics. Imagine they buy a lot of this unsold inventory and say, we're only going to give that to families that have 2 or more kids. Can they actually address some of this demographics? They're aware of the problem. You also have an issue with a lot of migrant workers in China are really locked out of the local economy, that they're not considered a citizen of the city they work in. And so that means they can't get access to healthcare, to education, to public housing. So reforming, they call it this hukou system, is another big factor. And then I think China will continue to move up the value chain in terms of upscale, value-added manufacturing, that they're kind of moving into. You see it with Huawei phones, and actually Huawei cars, right? Huawei went from being a maker of cheap, basically cheap knockoff phones. Yeah. The new Huawei ProMate 60 Plus is a better phone than an iPhone, just flat out, as well as they're actually getting into the car business because of this kind of connected technology, very similar to a Xiaomi, another player, cell phone manufacturing. So, again, this evolution of technology in China is a very, very real trend. And if anything, we think some of the previous administrations, some of those tactics of trying to shut or cripple Chinese companies, it forced them to innovate. Right? They're either going to go bankrupt or innovate. And if anything, I think those policies have really backfired. They've created a real problem for U.S. companies that are competing in that space. And Apple's iPhone sales were down in China. It had nothing to do with the domestic consumption economy. Mobile phone sales are up. It's just they're just not buying iPhones because there's better alternatives, particularly on the Huawei side.
Got it. So those are some of the sectors that will likely that you're positive on long term: consumer, healthcare, technology. What are some sectors that you think where the structural challenges will continue into the future?
I think just the shape of China's yield curve, it's so flat. The disparity between the 1-year deposit rate and the 10-year treasury is like, it's maybe like 20 basis points. It's really hard for banks to make money with the yield curve that flat. So I think financials is an area where we think, the big banks, they're big dividend payers, which is great. But we think financials, which is a big part of these broad indices, might struggle. Energy and material prices tend to be very much driven by commodity prices, and China's economy is still going to be dependent upon raw materials. But with this rise of domestic consumption, we think some of that demand, probably that those growth rates slow over time. So, I think again, raw materials, energy and materials, it's just going to be dependent upon, more of the raw material prices. Clean technology is another area we do like. I think, one of the areas that we think, President Trump will get a great deal on behalf of the U.S. Population. I think one area they'll look to address is overcapacity in areas like solar production. Like we're starting to see in electric vehicles.
Yeah.
That these Chinese companies really, they compete so much with one another that it really hurts their margins. And it's interesting that here in the U.S., you have one e-commerce company, Amazon, right? You have one EV company, Tesla. In China, there's dozens, right? On e-commerce, you have Alibaba, Pinduoduo, JD, Vipshop, ByteDance. On the EV side, I mean, it's obviously BYD, but NIO, Li, XPeng, Xiaomi, Huawei. I mean, Chery, Geely. I mean, it just, the list goes on. So yeah. So I think part of that will say, you got to deal with some of this overcapacity. You're actually hurting yourself.
Got it. Do you think that's structural, or do you see eventual sort of inevitable consolidation in China?
I think it's a bit of a structural issue that you have 16 years ago the Shenzhen government says this cell phone battery maker called BYD wants to build a car, so we'll give them a little bit of a subsidy. Lo and behold, I think they just sold 700,000 cars in the month of January. Hybrid and EV. I'm sorry, maybe it's 600,000.
Okay.
So then every other local government says, oh, well, we should do what they did.
Right.
And so lo and behold, you have 12 local governments giving subsidies to local car companies. And that leads to these Pyrrhic victories. You saw it with Uber and Didi years ago, where the two basically bankrupted themselves trying to compete. Who wins? Nobody. So I think we've seen that in the solar space. Just every local government saying we need a solar player, and just destroyed the industry. So in some ways, China is almost like the uber capitalist, and that's really hurt some of the profitability of some of the underlying companies. And I think that's you see that showing up as an issue, with Europe wanting to tariff Chinese EVs, saying, this is unfair, and arguably, yeah, you'd say it is.
Yeah, yeah. How do you see stimulus playing out? Will we get more of it? How would it flow to which areas in the economy? Do you see that sort of flowing into? And how is that going to help sort of stimulate the Chinese economy?
I mean, they've started stimulating. They've obviously cut interest rate. They've cut, the mortgage rate. They've provided a lot of capital to try to go into the stock market, into the real estate market. So they're looking to stabilize the stock market, the real estate. They've looked to clean up the balance sheets of local governments. That's because local governments employ a lot of people in the poorer provinces. Where we've seen explicit domestic consumption support has been auto, which includes EV and hybrid, as well as traditional internal combustions, but also home appliances. And why those two areas? Well, BYD employs over 700,000 people in China. So when you give a auto subsidy, people buy more cars, that means BYD is probably paying people more, giving bonuses. Why home appliances was obviously less apartment sales, less home appliances. But those home appliance makers, Haier, Gree, Midea, they each employ about 60, 70, 80,000 people. So if people are getting this stimulus, it actually helps those companies. So it is an implicit employment, and that's why we've seen recently they've done subsidies for electronics. You know, Foxconn employs 500,000 people in China. But if you look at other Apple ecosystem, other electronic players, if it's ZTE or AAC, Sunny Optic, they employ a lot of people in China, like 100,000 or more each. And so yes, you're doing a consumption policy, but it actually has an employment element, and we think we'll see more there, where what they've not wanted to do is just say, we're just going to give you money, go out, have a good meal, because it's here and gone tomorrow. So I think what they're doing incrementally is maybe smarter. Obviously, they're wary of creating inflation, creating debt, a consequence of some of the monetary fiscal support done here following COVID.
Got it. Let's shift gears a little bit to the Chinese innovation. DeepSeek obviously was a big deal, and really perhaps brought into question this American leadership in technology. China's trying to be a leader not only in AI, but also in areas like green technology, areas like next generation power like fusion, for example, robotics. Those are all areas where China is investing very heavily, and also space. Forgot to mention that. Where are they, in your view, relative to the American companies?
I think what DeepSeek did was obviously not feasible without OpenAI, but what they did was they gave it away for free, which is kind of amazing if you think about all that was invested in OpenAI and other players in the space. Billions of dollars of private equity, and this Chinese hedge fund high flyers said, "Oh, well, we just kind of did this, and we're just going to give it to you now." Now I think OpenAI will still be very successful because as an individual I can download ChatGPT or I can download R1, but big companies are going to do business with big companies, and now in China that'll be the Alibabas, Tencents, and there's a whole host of companies that have done very similar things that DeepSeek has done. They're not commercializing it for free. They're charging so I think DeepSeek is more kind of B2C, where the real money will be made kind of B2B, and that's true for OpenAI as it is for Alibaba and others. I think what DeepSeek really did was it exposed that everyone is really in one trade. This U.S. equity is really a Mag 7. It's a semiconductor, data center, nuclear energy, LNG. Everyone, everyone is in the same trade. They just call it different. They just put different labels on it. But it's all tied. And what DeepSeek really showed is really exposed how interconnected this one trade is, and that's a big problem. Just if you're able to do this, lower cost, lower energy, just better energy efficiency. It really might be very disruptive. And then think about what that does on the private equity side. Are these companies really worth what we say they're worth? If what DeepSeek said is true. And again, I don't think they could accomplish what they did without OpenAI building this foundation. And they built the second floor was faster and easier to build. But I think it just shows that there's an opportunity in cheap China tech, and people are really underweight. And as we saw, people are really overweight this one trade.
When you think about innovation, why do you think they will win? In other words, why do they have to win? What are some of the structural reasons why you think that they have to win? For instance, a lot of people talk about how America has the best university system
For sure.
in the world still. It's the country that still attracts the most innovative entrepreneurs, throughout the world. There's a very robust and free capital market, capital markets and venture ecosystem. Success is really really rewarded here. So those sort of elements, people will argue that those sort of elements are reasons why America will continue to lead in technological innovation. You could argue that China perhaps doesn't have what America has when it comes to these sort of factors that'll inevitably make China succeed in this sort of technological arms race. So in your view, if I'm somebody who's not convinced that China will win in this arms race, why do you think China will win over time?
Yeah, I don't see it as quite that black and white.
Okay.
I don't think it's a zero-sum game where, if China wins, then the U.S. loses, or vice versa. I think a lot of the geopolitical, a lot of the diplomatic speech is geared in this kind of confrontational. But if you take a step below, like look at these U.S. multinationals that are doing so well in China, and then conversely, a lot of Chinese companies are doing very well here in the U.S. And so business people don't view the world in this, zero-sum game. They're just doing fine, getting along with one another. And I think, if anything, when they temporarily banned TikTok, and even just DeepSeek, you have a lot of younger people saying, "Hey, I use this technology. It happens to be Chinese, but I don't care," and vice versa. And so, yeah, I think ultimately the diplomats seem to kind of view the world that way, but business people don't. It seems to be mutually beneficial. And then I think for a lot of younger people, and they seem to be getting along just fine with one another, and having just gone to 3 cities. I was shown a lot of hospitality and generosity, and was welcomed, and people wanted to hear my view, and vice versa. And so, I just think sometimes the diplomats speak that way, but maybe that's in their maybe they have some vested interest to kind of view the world in that kind of zero-sum game framework. I don't really view it that way.
Got it. No, I asked because you're right. I mean, it's not just black and white, zero-sum like that. In a lot of industries, if you things like Apple and Tesla, like you said, I think it's very likely they'll continue to be global businesses.
Oh yeah.
But when it comes to software technology, which is driving so much of the innovation of the future, it does seem like it's getting pretty sort of explicit in terms of software technology that powers the Western world and software technology that powers the China and Chinese allies. So it's sort of I sort of was asking from that standpoint.
Yeah. Well, I think, and certainly the way technology has evolved, that these chips can be used to be put into a Sony PlayStation or a mobile phone, but in theory they could also be used for national defense purposes. And so that is a gray area where it's understandable there's some trepidation about some of the exports. And vice versa, right? It works both ways. So I think if they can solve that issue, and some of that is just simply, the chips that the U.S. military needs probably should be built here in the United States. But is that mobile phone? I don't think it's feasible to build it here at this stage. Maybe over time with robotics. So there's a lot of things that need to be built there, and then I think. Some of this bring it all back. A lot of what China manufactures comes with an incredible environmental consequence, and a lot of people like to say, well, look at us. We've got these blue skies, but that's because the U.S. simply exports its pollution to these, emerging market countries, and it's out of sight, out of mind. And if you bring it back, then you're bringing back. I don't think there's any appetite for that.
Got it. We touched early on briefly about the sort of previous administration's measures to restrict access of advanced chips and such for the Chinese companies. If that continues on, do you think at some point that impacts the pace of innovation for Chinese companies? For now, like you said, perhaps it backfired, and the Chinese have figured out a way to do without those technologies. But eventually, if that kind of restriction continues, does that begin to impact the pace of innovation for Chinese companies?
Yeah. I mean, I think if it does, if that screw gets tightened, it's going to be a big problem for U.S. semiconductors. Because if you look at the exposure to China for Texas Instruments, for Qualcomm, for KLA, for NVIDIA, it's China is a big percentage of revenue, and it's going to be a big problem for those companies. And those companies have been really the market leaders here in the U.S. So I think it could slow some of the innovation in China. At the same time, it'll force, you have companies, semiconductor companies in China are being forced to grow, to put money into R&D, and in the medium to long run, that will be a big problem for these U.S. semiconductor companies, just because they'll lose that revenue potentially to the local players. I think the other thing is I think technology is it's more amoeba-like that. If you can tap into the cloud, then you're maybe using those banned chips through a data center on some other part of the world. Maybe that's from China. Maybe it's from a Chinese company operating in, I think it becomes very difficult to basically shut it off completely, just the way companies are innovative and the way technology has gone global.
Got it. What do you say to those who consider China uninvestable?
Well, I think I look at it two ways. One is that since the global financial crisis low, the S&P 500 is up over 1,100%, and people say, well, Chinese stocks are flat. But again, some of this is the sector composition, that only 2% of China was tech. And so when you brought broad-based MSCI China, no different than the MSCI emerging markets, you just had none of this growth, and you only had banks and energy, which are kind of slow, no-growth sectors, value plays. So some of this view of saying, well, this is what I think about China, and that's the performance. That's not, it's this index dysfunction. I do think there are things that have hurt Chinese stocks that were self-inflicted, zero COVID. Some of the internet regulation, the online education companies, some of the geopolitical. I think a lot of those factors have weighed on foreign investors, and it will take time to earn back that trust, for investors to have confidence to come back. And so I think China, needs to do some shareholder-friendly things. That I think part of what sparked the rally in Japanese equities 13 years ago, you could argue China's doing a lot of the same things, just doing it incrementally, buying ETFs, buying stocks from the government, forcing the companies to reform corporate governance, dividends, buybacks. So that path, that recipe for re-rating, I would argue, is there, and China is cheap. I mean, I just think people And valuations haven't been a catalyst. I mean, I 100% agree. But I do believe that if you can get a better improvement in U.S.-China relations, it will bring investors back into the space. And if you think that's not going to happen, then I think you should be really worried about your U.S. stocks that are at very high valuations, high China revenue, the Nikes, the Boeing, the Starbucks, the Caterpillars, particularly the semi plays, very high revenue exposure, which have really not been affected by some of this news up until very recently. And so, yeah, and again, I think you do have to volatility adjust because it is volatile in the space. And we've done some things around buffered and buffered ETFs to try to help mitigate some of that volatility in the growth names.
Okay. What are the most common mistakes that you see foreign investors make when they invest in China?
I think some of it can be actually the positioning.
Okay.
The size of your allocation, that I think you do have to volatility adjust the position. That if you have too big of a position, then it's hard for you to double down or dollar cost average. So we kind of say you got to volatility adjust the position or utilize some of the buffered or principal protected structured ETFs we've done recently that will help mitigate some of the volatility in the space. So I think that's something that I kind of caution people. I'm like, this is going to be more volatile than U.S. stocks. So yet you have to kind of go in with that, and maybe the position sizing is down, is just a little smaller than a normal position because of that expectation of volatility.
Got it. Well, that'll do for today.
Yeah,
thank you very much.
Yeah, thank you, Dan. That was great. Thank you so much.
Yeah. So that'll do for Global Money Talk today. Thank you for joining. See you next time.